Alright, let's skip the cute intro. You didn't click this video because you wanted a motivational speech about discipline and compound interest. You clicked because you want to know the truth, the real truth, about whether throwing a few $100 a month into the market can actually turn you into a millionaire. And I'm not here to sugarcoat it. I'm here to give you the math, the psychology, the traps, the hidden advantages nobody talks about, and the uncomfortable trade-offs you absolutely need to understand. So let's start with the part people almost always get wrong. This question, can monthly investing make me a millionaire, is actually the wrong question. Because the answer is technically yes, mathematically yes, historically yes, but practically, well, it depends on whether you can survive the very specific nightmare scenarios that come with the game you're trying to play. To understand that, we need to walk through 4 things. The math that proves monthly investing works, even if your contributions are tiny. The psychological traps that make most people fail despite the math being on their side. The timeline problem people never talk about, the thing that determines whether you'll actually see the million, and the secret advantage monthly investors have that wealthy lump sum investors would kill for. But let's start with the basic math and why it's both reassuring and wildly misleading. If you've ever watched those start investing $200 a month at 25 and retire with 1.1 million videos, you've seen the classic compound interest chart, the clean, perfect upward curve. The one that looks like it was drawn by a kindergarten teacher with a brand new pack of Crayola markers. The usual story goes like this. You invest a fixed amount every month. The market gives you roughly 7% real returns after inflation. And in 40 years, congratulations, you're rich. And mathematically, that story is correct. If you invest $200 a month for 40 years at 7%, you end up with about $480,000. If you invest $500 a month, you land at about $1.2 million. Increase that to $1,000 a month, and you're looking at about $2.4 million. Case closed, right? Well, not exactly. Because that math assumes 3 things that have never once been true in the real world. Assumption number 1. You will invest every month without fail. Most people miss months, sometimes for good reasons, sometimes because their car decided to inhale a spark plug. But the math assumes you're a robot that has never seen an unexpected dentist bill. Assumption number 2. The market gives you a clean, smooth 7% every year, which has literally never happened, ever. The market doesn't go up 7, up 7, up 7. Assumption number 3. You start early and stay consistent for 30 or 40 years. You know who consistently starts early? People in textbooks, not real humans. The average American starts saving for retirement in their mid-30s, which gives them maybe 30 years of compounding, if they're lucky. But here's the real twist. Even though those assumptions are unrealistic, monthly investing still works, and not for the reasons you've been told. People think investing is about maximizing returns. It isn't. It's about maximizing the probability that you survive long enough for compounding to matter. Because here's the truth nobody says out loud. All those incredible compound interest charts only work if you don't blow up your plan in the middle. You could get 12% a year for the first decade, 8 for the next, or even 15 for some lucky stretch, and still end up with nothing if you panic sell during a crash, or stop contributions for 2 years, or get laid off at the worst possible moment, or pick investments that blow up like a malfunctioning Tesla battery. You know what monthly investing actually does? It forces you to keep showing up. It reduces decision-making. It turns investing into a bill you pay, not a choice you debate. And that is why it works. Because the enemy is not the market. The enemy is us. Monthly investing works because it bypasses our worst instincts. But the trade-off, and this is the part nobody talks about, is that monthly investors pay a hidden cost that lump sum investors don't. And that cost is time. Here's a strange but extremely important fact. You don't get wealthy from returns. You get wealthy from duration. Most of the power of compounding happens in the last decade, not the first 20 years. If you invest $500 a month at 7% for 10 years, you have about $83,000. 20 years, $263,000. 30 years, $566,000. 40 years, 1.2 million. Look at that jump from year 30 to year 40. You gained 634,000 in the last decade, more than everything you earned in the first 30 years, combined. So the honest answer to can monthly investing make me a millionaire is this: yes, but only if you stay invested long enough to reach the part of the compounding curve where the magic actually happens. And that's where things get tricky, because if you start at 35, you need to be consistent until 65. If you start at 40, you need to be consistent until 70. If you start at 25, you have flexibility, but most people don't start at 25. So the real question isn't whether monthly investing can make you a millionaire. It's whether your life circumstances will let you stay in the game long enough. This is why we need to talk about the psychological traps. And trust me, these matter way more than your contribution amount. If you've ever tried to stick to a workout routine, you already know how this story goes. We're not logical creatures. We're pattern-seeking, panic-prone, distraction-addicted, loss-averse mammals pretending to be rational. And the market exploits that every single year. Most people think they're a little behind on saving. They're not a little behind, they're a decade behind. The difference between starting at 25 versus 35 at $500 a month is staggering. Start at 25, you end up with roughly 1.2 million. Start at 35, you end up with about 566,000. That's a $600,000 difference, all because of when you started. But humans are terrible at understanding exponential growth. We think in straight lines. So when we tell ourselves, I'll start next year, what we're actually saying is, I'd like to cut hundreds of thousands of dollars off my future net worth so I can buy a slightly nicer couch today. But that trap is nothing compared to the next one. Imagine this. You've been investing $500 a month for 5 straight years. You've built up around 35,000. Then the market drops 30%. Your balance falls to 24,500. That's 10 years of contributions wiped out in 6 weeks. Or at least that's how it feels. And even if you intellectually know this is part of the plan, your brain does not care. Your brain is yelling, get out before it goes to zero. This is why most people lose. Not because of bad investments, not because of low income, not because of poor math. They lose because they sell during the one moment they absolutely must not. And here's the dark irony. Monthly investing works best during crashes, precisely when people most want to stop investing. Then there's the slow killer, lifestyle creep. Lifestyle inflation is the silent assassin of compounding. Every raise you get feels like a lifeline, and then, mysteriously, it disappears. Your rent grows, your car gets nicer. Your takeout orders increase like they're compounding themselves, and suddenly, that $500 you used to invest monthly becomes $300, then $200, then I'll make it up later. Monthly investing relies on consistency. Lifestyle creep is inconsistency disguised as progress. And that's the elephant in the room. Very few people have 30 consecutive years where their expenses behave. But here's where things get interesting. Despite all this, monthly investors still have a secret superpower. And it's something almost nobody realizes until after they've become wealthy. Rich investors invest differently. They don't dollar-cost average. They do lump sum investing, meaning they drop huge chunks of money into the market all at once. And mathematically, lump sum investing beats monthly investing about 70% of the time because markets go up more often than they go down. But lump sum investors are also exposed to catastrophic timing risk. Imagine you invest $300,000 the week before the 2008 crash, or the week before the 2000 dot-com collapse, or the week before March 2020. You're not down 10%. You're down 90,000 or 120,000 or more. Most people couldn't emotionally survive that. Here's the secret everyone forgets. Monthly investors don't have timing risk. They eliminate it by design. Each contribution is spread across thousands of different market conditions. Some months you invest at the top, some months you invest at the bottom. Most months you invest somewhere in the middle. Over decades, that gives you something incredibly valuable, the average. And while the average doesn't sound exciting, it is exactly what you want, because the average of the stock market over long periods is good enough to make you wealthy, and far better than what most emotional decision makers get. Monthly investing turns volatility from something dangerous into something useful, which brings us to the question you actually care about. Can you, personally, become a millionaire through monthly investing? Let's break that down, realistically. Let's strip out the fantasy scenarios and get brutally practical. There are really just a few situations where monthly investing will almost certainly make you a millionaire. If you start early, before 30, even with modest contributions, $300 to $500 a month, starting young basically guarantees success. You have the one resource compounding needs most, time. If you start later, say 35 or 40, you can still get there, but the contribution needs to be higher. $500 to $700 a month at 35, $1,000 or more at 40. It surprises people, but it shouldn't. Compounding isn't linear. Then there's the most common real-world path, increasing contributions over time. Your income rises, your savings rate rises with it. You start at $200 a month and end up at $800. Messy? Yes. Effective? Extremely. Another key? Treat investing like a bill, not a choice. Automation is your best friend. If you automate it, you'll stick with it. If you don't, you won't. Simple as that. Here's the honest, unfiltered answer. Yes. If you follow the rules, the math assumes you will follow. But those rules are harder than they look. Monthly investing works not because it's mathematically optimal, but because it's psychologically survivable. And the real question isn't whether monthly investing can make you rich. It's whether you can behave in a way that lets compounding do its job. So now that we've broken down the psychology, the traps, and why monthly investing works despite its flaws, let's move from theory into the mechanics, the part where numbers, behavior, and systems actually turn this idea into real money. The question everyone wants answered first is simple. How much do you actually need to invest each month to become a millionaire? Now, most of the charts you see online assume a perfect 7% real return, consistent contributions, and zero interruptions. But real humans don't live in spreadsheet land. Real people change jobs, move cities, have kids, go through recessions, face surprise expenses, get sick, get raises that mysteriously vanish. So instead of fantasy numbers, let's look at what actually works in real life. If you're in your 20s, congratulations. Not because you're young, but because you have the most powerful financial force on earth, time. To reach 1 million by 60, assuming a realistic 6 to 7% real return, at 22 you'd need around $300 a month, at 25 about $400, at 28 roughly $500. Those numbers work even with occasional interruptions. If you're in your 30s, which is most people, to hit 1 million by 60, at 30 you're looking at around $650 a month, at 35 about $900, at 38 $1,100. And for the first time, those numbers start to feel heavy. That's not a coincidence. Compounding is front-loaded on time. By the time you hit your 40s, the math gets brutally honest. To hit 1 million by 65, at 40 you'd need about $1,700 a month. At 45, $2,700. At 48, $3,600. Can it be done? Yes. But you'll need either a high savings rate, a high income, or a radical lifestyle shift. Here's the uncomfortable truth most people avoid. Most people don't become millionaires because they wait until the numbers become too big to be practical. Not because investing doesn't work, not because compounding is a myth, but because the timeline is unforgiving. Monthly investing is a timeline game, and time doesn't negotiate. Now let's talk about one of the biggest misunderstandings in the investing world: market cycles. People think bull runs, crashes, and recessions are dangerous for monthly investors. But in reality, they're a gift. Think about it. In bull markets, when prices rise, everyone feels smart. Your balance goes up, you check your portfolio too often, you start walking differently because your net worth is inflating your ego. But bull markets don't actually help monthly investors that much. You're buying fewer shares at higher prices. Those contributions do the least for your future wealth. Now look at flat markets. Those periods when prices stagnate. Nobody likes them. They feel boring, pointless, like financial purgatory. But flat markets are a goldmine for monthly investors. Prices are stable, emotions calm down, and you accumulate tons of shares quietly. Historically, every long flat period is followed by a massive bull run. And the people who kept investing during those boring years benefit the most when it comes. And then there are bear markets, the villains, the nightmares, the moments everyone fears. But here's the truth nobody says out loud. Bear markets create more future millionaires than bull markets ever have. When the market drops, your contributions buy shares at fire sale prices. A 30% crash means your money buys 43% more shares. A 50% crash means your money buys double. Crashes aren't setbacks, they're accelerants, but only for the people who survive them. That's why monthly investing works. It makes surviving easier. And speaking of survival, let's talk about the backbone of monthly investing: automation. If you take nothing else from this, remember this: discipline is overrated. Automation is the only thing that works long-term. Here's the simple framework that nearly all long-term successful monthly investors follow, whether they realize it or not. First, pay yourself first. Literally, first. If your investments aren't automated on payday, you're not investing. You're planning to invest. And plans don't build wealth. Systems do. Automation removes willpower from the equation, which is perfect because willpower is unreliable, moody, and easily defeated by burritos. Next, keep your portfolio simple. Most millionaires didn't use fancy investments. They used total market index funds, S&P 500 index funds, or target date funds. Simplicity wins because people stick with simple and abandon complicated. Then, set contribution floors, not goals. Most people set goals like, I'll invest $600 a month. Don't. You set your minimum, not your ideal. I invest at least $300 no matter what. Anything above that is a bonus. That's how you prevent the all-or-nothing failures that destroy consistency. After that, build lifestyle creep resistance. Whenever your income goes up, increase your contribution rate before you increase your lifestyle. The wealthy don't invest because they're wealthy. They became wealthy because they raised contributions every time they got a raise. And finally, use rule-based adjustments. Every 12 months, do a reset. If your income rose, increase contributions. If your expenses fell, increase contributions. If you had a surplus year, increase contributions. No emotions, no vibes, just rules. That's how monthly investing turns from something you do into a structural part of your life. Now, let's talk about one of the most powerful but least talked about strategies. One that quietly beats 90% of investors. It's called ratcheting contributions. Here's how it works. You start small, $50 a month, $100, whatever you can manage. Then every year, you increase it by a rule. 5% of your income, or $50, or $100. Doesn't matter which, only that it's automatic. Here's what happens. Year 1, $100 a month. Year 2, $150. Year 3, $200. Year 7, $400. Year 10, $650. Year 15, $1,000. By year 20, you're contributing at wealthy person levels, without ever feeling wealthy. This strategy beats ordinary monthly investing because it matches your contributions to your earning power. Income grows, contributions grow, wealth explodes. That's how most self-made millionaires actually do it. They didn't invest huge amounts early. They built the habit early, then scaled it. Now let's address the big question. The one that makes everyone a little uncomfortable. Is monthly investing actually enough to become wealthy in the modern world? The honest answer is yes, but not for the reason most people think. Monthly investing doesn't work because the returns are amazing. It works because it's survivable. It's stable. It keeps you in the game. It scales with your income. It works in every market condition. And it protects you from yourself. Millionaires aren't made through brilliance. They're made through duration. Monthly investing isn't the fastest path. It's not the sexiest path, but it's the most reliable path. And here's the kicker. Almost everyone who sticks with monthly investing for 30 years or more ends up wealthy, even if they never earn a high income. It's not about timing. It's not about luck. It's not about intelligence. It's about staying invested long enough for the compounding curve to bend upward. If you can do that, $1 million isn't just possible. It's likely. So here's your roadmap. Start small. Automate everything. Increase contributions yearly. Survive the crashes. Ignore the noise. Stay for the full ride. If you do these things consistently, then yes, monthly investing can absolutely make you a millionaire. But more importantly, it will make you someone who can actually stay wealthy. And that, honestly, is the real goal.